Hi there, and welcome to the Brunsdon Investment Market Update. 2017 has started in a very positive way, I'm pleased to say, and we have with us Frank Atkins from Brooks Macdonald, who are the investment managers who look after the IFSL Brunsdon Investment Funds. Hi there, Frank.
Thank you, Brian. Nice to be here.
Frank, I have some questions that a number of our clients are asking us these days, and I wonder if you would shed some light, perhaps from yours and Brooks Macdonald's point of view. Of course, the one which comes up most often is to do with Donald Trump becoming the new president of the USA. And the question, couched in many different terms, is how will Donald Trump affect world markets, and how indeed might you be repositioning the investment funds to accommodate them?
Thanks, Brian. Well, it's a very interesting and multifaceted question, I suppose. What the election of Donald Trump did bring, first and foremost, is certainty. If we cast our minds back to before the election in November, markets were very jittery, and that is because nobody knew whether it was going to be Clinton or Trump. Now that we have had certainty of Trump's election and subsequent inauguration, markets are then able to take stock and decide where they go from here. And they've certainly decided that Trump is positive at the present time. It's not the disaster that some people predicted. The S&P 500 reached record highs at the end of 2016 and has continued in a general upward trend at the start of 2017. But what we don't really know yet is what Donald Trump's policy agenda will be, and that's really the interesting side of things. There's a lot of speculation that he will reduce the regulation on the banks, the Wall Street banks, which brings opportunities for the banks specifically, and that's why banking shares have rallied. But there are also concerns as to whether we may then see some kind of repeat of the 2008 crash at some point in the future, if regulations are eased on investment bank operations, and obviously if that goes wrong again, that can have knock-on effects for the whole economy. So that's something that we will need to watch very carefully. But in terms of the management of the funds, we don't really make large asset allocation decisions based on political events or elections. We're broadly positive on the US market. There are some very good companies operating especially in the smaller sections of the domestic US market, and of course the dollar itself remains very strong. So we're happy to maintain a sizable allocation to the US at the current time.
Okay, thanks, Frank. Also, a very often asked question is to do with Europe, and of course our decision with regard to Brexit, and how the politics in particular up ahead could affect investment markets. I wonder what your thoughts are on that, please.
Yeah, absolutely. I think that's one of the major issues that are affecting markets at the moment. We've seen in the last week the yield on Greek government bonds rise above the 10%. It has recently dipped back under the 10%, but the 10% mark is a warning signal to Europe. There are a number of reasons why that happened. The first one is that the IMF raised the question as to whether Greek debt was sustainable and whether debt relief should be considered. And that is out of step with the opinion of the European Central Bank, Mario Draghi, and especially the German government and the Bundesbank. And that's the first time that there's really been a sort of a difference of opinion over the last sort of 4 or 5 years. Everyone has been in consensus on that subject, that Greece should continue down its pathway to austerity. It should be running a surplus of 1 or 2% per year, and it should get its way out of its trouble like that. But the pressure that is sort of being put on Greece and Greek society, the economy there, is not really showing signs that pathway is really sustainable anymore. And so markets have got wind of this changing of opinion from the IMF, and they are starting to reassess really whether the Greek bond yield is sustainable. The second part of it is that we have upcoming elections across Europe, starting in March. We have the Dutch election. The French election will then follow in April, and at the end of the year, towards October, there will be a German election. Now previously, it was sort of considered impossible, I suppose, that any of the populist parties in Europe would be elected. But the Brexit decision and the election of Donald Trump has sort of changed people's opinions on that kind of thing. And so if any of those dominoes were to fall, shall we say, in Holland, France and in Germany, that would then create a serious risk-off event in Europe, and it would cloud everybody's views on the whole European project and the sustainability of the euro itself. In terms of how we see Europe at the moment, in the absence of these political events, I think that European equities are looking very, very good. They've been posting some very strong returns in 2017 so far, and we're happy to maintain an above average allocation to Europe, but we just have to be mindful that if we do see any political shocks, there could be a sell-off involved.
Okay. Coming a little bit closer to home with the UK economy, how do you see that Theresa May's handling of the Brexit situation will impact the UK economy?
Well, I think Theresa May has done as good a job as she possibly could do so far. It's a very difficult position that she is in, but nonetheless what she has brought is clarity to the situation. I mentioned previously that markets don't like uncertainty, and they were certainly indicating that with the fluctuations we saw in sterling before we had clarification from Theresa May about what the UK would be looking for when we go into the negotiations in full, which will start to occur after the triggering of Article 50 at the end of March. Theresa May was very clear, and she said that she was prepared to walk away she was saying that no deal is better than a bad deal. And essentially what that means is that markets can then start to price in the event of a hard Brexit. So that is a reversion to World Trade Organization trading rules and tariffs. But like I said, what it means is they can then accurately price sterling in the worst case scenario, and that has enabled sterling to steady. Sterling has been a key driver of the FTSE 100. A weak sterling tends to push the FTSE 100 up because a lot of the companies in the FTSE 100 make their profits abroad, and so they are more attractive to UK investors when those profits are converted back into sterling. But it's interesting, over the last few weeks we started to see a breakdown of that correlation between lower sterling and higher FTSE 100. And I think what we will see as we progress through the negotiation period is that the various different sectors, you've got the auto sector, we have the oil and gas sector, mining, etc., we will start to see a lot more of a reaction within those sectors depending on the news flow that starts to come out of the negotiations. So that's something we have to be careful of. We continue to be happy to back the UK, but I think it will be a lot more important to be picking winners in these individual sectors rather than just allocating across the whole index.
Okay, that sounds pretty positive for the near-term view ahead. Where would be the dangers? What dangers do you see up ahead that we should be conscious of?
Well, there are always dangers on the horizon. I mean, I suppose you could say that it's the danger that you don't see that gets you, the one that comes from left field. But the ones that we can see, we've touched on the political risk in Europe. I think any of the upcoming elections in Europe would have the potential to pose a systemic risk to markets across the world. So that's something we have to be careful of. The second really is China. It's always good to keep monitoring China. There's talk of what happens in the event of a Chinese hard landing. China has been increasing its levels of leverage within the economy. Some commentators say that these are at unsustainable levels. Some people are concerned that perhaps the figures that are coming out of China with regards to GDP and employment are not all they possibly might be. And so if we were to see a large movement of capital out of China, which would indicate that things were not well, then that's something that we would have to react very, very quickly to. I don't think that you can class Donald Trump as a risk per se, but there is always the question of his policy announcements, which many of them are yet to come. If they are taken negatively by world markets, then obviously that would be a very bad thing.
Thank you very much, Frank, for those comments. They sound very positive in the main, and let's hope that the trend continues. Thank you all for listening to the Brunsden Investment Market Update. The Brunsden IFSL funds continue to perform very well. And as always, if you have any questions or queries, please don't hesitate to be in touch with us here at Brunsden. And here's to a good 2017. Thank you.